Hello, welcome to the channel. Our goal is to take complicated topics and simplify them to make it easy to understand. So please don't forget to like, share, subscribe, and leave a comment if there's a topic that you want me to cover in a future video. So today we're going to be talking about living trust. So a living trust is one of those things that we've heard about, but we never really looked into it deep enough to see if there's something that we really need or not. And in some cases, we just automatically assume that's only for wealthy people and we don't even qualify. So by the end of this video, you'll have a strong understanding of exactly what a trust is, and you'll be able to make a determining factor if it's something that you need to move forward with. So a trust is just a legal contract mainly used for estate planning. And your estate is just comprised of everything that you own personally. So you may have been driving down the street in the past and saw a sign on the pole that says estate sale. So pretty much all that means is the person passed away and they're selling all of their property to raise money. So there are three main parties that make up a trust. And it's very important to know what they are and what they actually do. The three parties are the grantor, the trustee, and the beneficiary. The grantor is the individual that sets up the trust. They determine all the rules and all the outcomes of the trust. Sometimes you'll hear the word settler, and if you do, just know that the settler and the grantor are the same thing. Next, you have the trustee. Now, the trustee is the person that actually manages the trust. And everything they do must be in the interest of the beneficiary at all times. And then you have the actual beneficiary. The beneficiary is who's going to receive the assets when the grantor dies. So you have the person that sets up the trust, the person that manages the trust, and the person that will benefit from the trust. And even though I'm using the word person, just know it can be an entity as well. Now, before you start stressing out about who's going to be the person you want to manage all your assets, there's an important factor that you really need to know. During your lifetime, you can actually hold all three positions at the same time. So you'll be the trustee while you're alive, and then you'll appoint a successor trustee that will take over in the event that you pass away, or you get to the point where you can't manage the assets for yourself. So just know you do not have to give up control over your assets while you are alive. So from an operational perspective, really nothing changes when you have a trust, except for maybe how you sign certain documents. And you'll also appoint a successor beneficiary, and that's the person that's going to receive the assets in the event of your death. A big misconception that I hear a lot is that people think a trust is an actual account, and it is definitely not an account. It's an entity that can hold your assets like real estate, your business, financial accounts, life insurance, and other assets in your name. It can also be the beneficiary of those assets as well. A lot of the time, people will list a trust as the beneficiary of their life insurance policy. And the reason for doing that is because once the death benefit pays out, whether it be a few $1,000s or a few $1 million, you can specifically say what happens to the money and when. You may not want your beneficiary to receive that entire death benefit all at once. So a trust is a great way to solve that problem. So exactly how do you get your assets inside of a trust? In order to do that, you have to do what's called funding the trust. And that's just a fancy way of saying you need to change the title ownership from your name to the name of the trust. So when you set your trust up, you actually give it a specific name that you choose. And when you do put items in the trust, just know you can add and remove at any time, which means you still maintain complete control of your assets, even though you put them inside of the trust. And that's really important, especially when you start dealing with real estate and businesses. Because during your lifetime, more than likely, you'll be buying and selling various assets. And you also maintain the ability to add and remove beneficiaries whenever you like as well. So as new children are born into your family, you can add them to the trust with no problems. And of course, you could do the same thing if one of your children were to get married. Now, one of the main reasons people put assets inside of a trust is to avoid probate. Probate is just the legal process of reviewing a deceased person's assets and determining who's going to inherit what. It's a very lengthy process, and it could take months or even years to complete. For example, Prince passed away in 2016, yet his probate didn't complete until August of 2022. That's 6 years in probate. And I'm pretty sure if you can avoid it, you'd want to avoid that type of probate situation. And there's no direct connection to how much money you have versus how long your probate's going to take either. Another non-exciting fact about probate is that it's public record, which means I can literally hop on Google and see exactly what's going on with your probate process. I'll even get the details of who had inherited what. And probate's also known for being pretty expensive. Usually you'll pay a percent of whatever assets are involved. And when you think about it, that could get pretty expensive fast, especially when there's real estate involved. So always remember there are 3 different scenarios that can happen when you actually die. You can die with no will, and in that scenario, all your assets go through probate. Scenario number 2 is that you die with a will. Now, when you die with a will, all your assets are still in your personal name, which means you still must go through the probate process. But it will be used as a guide to help navigate through the probate process. And that's important to know because a lot of times people believe a will is going to help them avoid probate. And unfortunately, that's definitely not the case. And the third scenario is that you die with a trust. Now, when you die with a trust, those assets are technically not in your name anymore. They're actually in the name of the trust, and that's how you bypass the probate process. So it's not just important to have a trust, but you have to make sure it's funded properly and those assets go from your name to the name of your trust. Otherwise, you completely miss the benefits of having a trust. And there are some other exemptions that allow you to bypass probate. If someone's estate is small enough, certain states will allow you to bypass probate. Also, certain retirement accounts that have designated beneficiaries can also bypass the probate process. Another reason someone may set up a living trust is to manage assets after their death. Minor children is a big one because without a living trust, you'll have to hope someone's going to provide for your minor child. But when you have a trust set up, you can say specifically how you want your child to be taken care of financially, especially when life insurance is involved because a death benefit cannot pay out to a minor child. So you run the chance of your child not receiving any financial benefits during their childhood, and then when they turn 18, they'll get all the money all at once. And since an 18-year-old is legally an adult, they can do whatever they want with the money. So a living trust can help manage that scenario. And the same thing applies for your adult children. You may want to stagger wealth for them as well. An example of that is having your child receive payments at age 21, 25, 30, and maybe a final lump sum at age 35. You can also use a trust for asset protection for your beneficiaries. Sometimes people want assets to stay inside the trust and never go to their beneficiary's personal name. And there are a few different reasons why people do this. It could be to protect them from their creditors or even lawsuits. Or you may want to leave the money inside the trust to create a family bank for future generations. Just know having a trust gives you a chance to really design your legacy. So hopefully you have a better understanding of what a trust is and different ways you can use it. And always speak to a financial professional or a state attorney to determine what's the best situation for you, because different states have different laws. So if you received any value, definitely like, share, subscribe to the channel for more financial and business content.